The stock market returned 10% last year. The average investor captured 3.7% of it. Same market, same decade, completely different engines. That is not a motivation problem, that is a structure problem. Think about that. The concept we are breaking down today is called the two-asset engine, and by the end of this, you will understand exactly why your wealth feels frozen and what actually has to happen before it starts moving on its own. You are not broke. You are not irresponsible. You earn a real income. You have some savings. You have probably read enough to know that investing matters, and you have probably done at least part of it. But you are doing it in one lane, waiting for one thing to grow and wondering why the numbers feel like they are standing still. This video is built for you specifically, not the beginner, not the millionaire. You, the person in the middle, doing the right things but missing the mechanism. That is the gap we are closing today. Here is what nobody tells you about the early stages of building wealth. Slow does not mean broken. Slow means the engine has not engaged yet. Wealth does not grow in a straight line. It grows in a curve, flat and frustrating at first, then steep and almost violent in its speed once the compounding crosses a threshold that most people quit before reaching. The problem is not that your investments are performing badly. The problem is that one asset growing alone is working at half capacity. The real acceleration does not come from one thing compounding. It comes from two things compounding simultaneously, feeding each other, creating a loop that eventually runs without much input from you. That loop is what we are building today. Most people approach wealth like they are pushing a boulder uphill. They push, the boulder moves a little, they rest, the boulder rolls back, they try again, they get exhausted, they blame the hill. But wealth, when it is structured correctly, stops requiring you to push. The boulder starts rolling downhill, not because you got lucky, because the two assets you built are now generating returns that reinvest into each other, and the math starts working for you instead of against you. Before we get into the specific two assets, you need to understand why single asset investing feels like treading water even when the numbers are technically going up. Imagine you put $50,000 into one investment. At a 10% annual return, after year one, you have $55,000. After year two, $60,500. After year three, $66,550. Progress, yes, but meaningful? Not yet. Not in a way that feels like freedom or momentum. Not in a way that changes your daily decisions. Now watch what happens when you build a second asset simultaneously, one that generates income rather than just growth. That income does not sit still. It gets redirected back into the first asset. And suddenly, you are not waiting for one thing to grow. You are watching two engines running at the same time, one generating growth, one generating income, and the income accelerating the growth, and the growth eventually boosting the income. That is the two-asset engine. And no, it is not complicated. It is just almost never explained this clearly. Drop one word in the comments, engine. That single word tells me exactly where you are in this process. If you haven't started investing yet, type engine, not started. If you've got one asset working, type engine, started, and this video will show you what to add next. If you already have both assets, type engine and use this moment to check whether they're actually connected or just sitting in parallel. One word, engine. Let's see who's genuinely serious about what we're building here. Let us talk about what the two-asset engine actually is, because it is not a theory. It is a two-part structural decision that most people arrive at eventually, but usually only after years of trial, frustration, and missed compounding time. Asset 1 is a broad market index fund, not a single stock, not a sector bet, not something your coworker mentioned. A total market index fund or an S&P 500 index fund, both of which give you exposure to hundreds or thousands of companies in a single instrument. When the economy grows, you grow. This is the growth engine. Asset 2 is a dividend-focused investment. This could be a dividend index fund, a dividend ETF, or a collection of individual dividend-paying stocks. Unlike a growth fund, which makes money by increasing in price, a dividend asset makes money by sending you regular cash payments just for owning it. This is the income engine. The reason these two work together is not coincidence. It is mechanics. The dividend income you receive from Asset 2 gets reinvested into Asset 1. That reinvestment increases the size of your growth position without you adding new money from your paycheck. Asset 1 grows faster. As Asset 1 grows, you periodically rebalance and add to Asset 2. Asset 2 generates more income. The income feeds Asset 1 again. The cycle continues. Each rotation is slightly larger than the last. This is not a metaphor. This is how the math actually behaves. The reason most people never activate this loop is not financial. It is psychological. One asset feels like enough. You open the account, you set up the transfer, you feel like you did the thing, and technically you did. But one asset is a boat with one oar. You will move, but you will move in circles. The second asset is the second oar. And the moment both are in the water, moving in the same direction, the boat starts going somewhere. Most investors also make the mistake of treating dividend income as bonus money. Something to spend, something to celebrate. The investors who build actual wealth treat dividend income as structural fuel. They never touch it. They redirect it automatically. They do not even think of it as money they own yet. It is the engine feeding the engine. This is not about discipline. It is about design. If your brokerage account is set up to automatically reinvest dividends, the behavior happens without you. You do not need willpower. You need the right structure. There is a concept in physics called escape velocity. It is the speed an object needs to reach to break free from a gravitational pull. Below that speed, gravity wins. Above it, the object keeps moving on its own. Wealth has an escape velocity too. Below a certain portfolio size, your monthly contributions matter more than your returns. The compound growth is too small to feel significant. You are still doing most of the heavy lifting. But above a certain threshold, the math flips. Your returns start generating more new wealth than your contributions do. That is escape velocity. And the two-asset engine reaches it faster than a single-asset approach because you are compounding on two fronts simultaneously. The question is not whether you will reach escape velocity. The question is how many years you are willing to delay it by running only one engine. Let us be direct about the timeline, because false expectations are one of the primary reasons people abandon wealth strategies too early. Years 1 through 3, you will not feel it. The numbers grow, but slowly. The dividend income is small. The reinvestment adds fractions of shares. You might question whether any of this is working. This is normal. This is how compounding works. The curve is flat here. Years 4 through 7, you start noticing. The dividend payments are no longer trivial. The reinvestment is now adding meaningful positions. Your growth fund has crossed a threshold where its annual gains are larger than what you started with. You start to understand viscerally what compounding means. Years 8 through 15, the engine is running. The dividends are generating thousands, not hundreds. The growth fund is doubling at intervals that feel almost absurd compared to where you started. You are adding less and receiving more. The ratio has shifted in your favor. Year 15 and beyond, the two-asset engine is running without meaningful input. It is generating wealth independently. You are not pushing the boulder. The boulder is rolling. But none of this starts until you build both assets. One alone will get you there eventually. Two together get you there years earlier. Years of compounding you cannot get back. Now let us talk specifically about which instruments to use, because this matters regardless of where you live in the world. If you live in the United States, the implementation is straightforward. For your growth engine, Asset 1, look at funds like VTI, which is Vanguard's Total Stock Market ETF, or VOO, which tracks the S&P 500. Both are available through virtually every major brokerage, including Fidelity, Schwab, and Vanguard directly. You can open an account in under 30 minutes. You can start with as little as $1 on many platforms. For your income engine, Asset 2, look at funds like SCHD, which is Schwab's Dividend Equity ETF. It holds high-quality dividend-paying companies and has a history of growing its dividend over time. VYM from Vanguard is another solid option. Both are available on the same platforms where you hold your growth fund. Set the dividends to automatically reinvest into your growth fund, and the loop begins. If you live outside the United States, the strategy is the same. The instruments are slightly different. In the United Kingdom, you can access similar index funds through platforms like Vanguard UK, Hargreaves Lansdowne, or Trading 212. Look for a global index tracker as your growth engine and a global dividend fund as your income engine, both held inside an ISA to protect your gains from tax where possible. In Canada, platforms like Questrade or Wealthsimple give you access to ETFs like XEQT for growth and XDV for dividend income. In Australia, platforms like Stake or CommSec allow access to both local ETFs like VAS and international ones like VGS. For most countries in Europe, Asia, and Latin America, platforms like Interactive Brokers provide access to US-listed ETFs depending on your country's regulations. In some regions, you may need to use UCITS versions of these funds, which are European compliant equivalents. A quick search for UCITS equivalent of VTI or SCHD will show you what is available in your jurisdiction. The mechanism is identical regardless of geography. Growth fund plus dividend fund, dividends reinvested into growth, contributions added consistently. The platform is just the container. The engine is the structure. Now, if you're thinking, okay, but where do I even build a portfolio like this? Here's where I'd start. If you're looking for a platform that does feel modern, transparent, and built for long-term investors, Public.com is a solid place to begin. It lets you buy fractional shares, follow expert insights, and invest with confidence. And for new starters, they do offer helpful onboarding support through real human chat, clear step-by-step guidance, and an easy account setup process that makes getting started feel simple. I'll leave my link below where you can open your account and explore your options. It's simple, but it could be one of the smartest financial moves you make today. Now, let us run the numbers with two real people. Call them David and Priya. Both are 30 years old, both have $10,000 to start. Both can contribute $300 a month. They are identical in every financial variable except one. David puts everything into a single growth index fund. Priya splits her approach and runs the two-asset engine. David, after 20 years, with an average annual return of 10% and $300 monthly, ends up with approximately $260,000. Solid, real. Not bad for 20 years of consistency. Priya, running both assets simultaneously with her dividend income being reinvested into her growth fund, effectively increases her compound rate modestly but consistently. The dividend reinvestment adds roughly 1.5% to 2% in additional annual return over time, because she is buying more shares with each dividend cycle, and those shares generate their own dividends, which purchase more shares still. After 20 years, Priya's portfolio is closer to $310,000 to $330,000. That is a gap of $50,000 to $70,000 from the same starting point, the same monthly contributions. The only difference is the loop. Now extend that to 30 years. David's single-asset approach reaches approximately $600,000. Priya's two-asset engine, compounding that dividend reinvestment loop for a full 3 decades, approaches $750,000 to $800,000. The gap has widened to $150,000 or more. That is not a marginal difference. That is a life-altering difference. That is the cost of running one engine when two were available. Pause here for just a moment. If this framework is making sense to you, if you can see the structure and you want more of it, subscribing to this channel takes 3 seconds, and it means every future breakdown comes directly to you. No algorithm guessing, no searching, it just arrives. We cover wealth strategy the same way every time. Clear, specific, no noise. If that is what you are looking for, the subscribe button is right there. Now back to the work. Understanding the two-asset engine is one thing, tracking it is another. And this is where most people lose momentum even after they build both assets correctly. They do not have visibility. They do not see the loop working in real time. They cannot tell whether their dividend reinvestment is actually accelerating their growth fund or just sitting there. They cannot see their net worth moving month by month in a way that connects all the pieces. That is exactly why we build the Trip to Wealth Command Center, a Google Sheets system specifically designed to bring every financial variable you are managing into one visible place. Your income, your spending, your assets, your dividend reinvestment progress, and your net worth trajectory, all in a single dashboard that updates as you update it. The Command Center does not replace your brokerage. It translates your brokerage into a language your decision-making brain can actually use. When you can see the loop running, when you can see that last month's dividends bought additional shares that generated this month's additional dividends, the behavior changes. Not because you became more disciplined, because you became more informed. The system also surfaces money leaks, places where your income is evaporating before it reaches your engine. Most people discover 2 or 3 of these leaks within the first 30 days of using a visibility system. Redirecting even one of them can add thousands per year to your compounding base. The Command Center will be out this week, and early access spots are available below this video. Early supporters get a discount and 2 companion frameworks that complete the system. If you are serious about running the two-asset engine with full visibility into how it is performing, that link below is where you start. Your strategy needs a dashboard. This is it. Here is the honest reality about the gap between people who build wealth and people who spend their whole lives feeling like they almost did. It is not intelligence. It is not income. It is not luck. It is not even discipline in the traditional sense. It is structure. Specifically, it is whether or not you built a mechanism that works when you are not paying close attention to it. Single-asset investors rely on one thing to do all the work. Two-asset investors build a loop that compounds itself. The difference in outcome over 15 to 20 years is not incremental. It is foundational. You already have the information now. You know which two assets. You know how they connect. You know what the math looks like across 20 and 30 years. You know how to implement this whether you live in the United States or anywhere else in the world. You know what the engine looks like when it is running. The only question left is a structural one, not a motivational one, not a personal development one, a purely mechanical one. Is the loop built or not? Because the people who are watching wealth compound in year 12 and year 15 did not have more information than you do right now. They had a structure that was running while they were living their lives. The two-asset engine does not require your constant attention. It requires your initial decision and a system that executes it consistently. Everything else is just waiting for the curve to bend. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. Always assess your risk tolerance and investment goals before allocating your capital. And if you found value today, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below. I appreciate your support. Until next time, stay consistent, stay patient, and stay winning. See you in the next one.